Hello friend and future deep dweller. You know the fundamental assumption in investing. If you as an investor take on more risk, you should be rewarded with high returns, or at least the possibility of higher returns. So part of this stems from, well, first just the basic idea that no sane person would willingly take on more risk unless they believed it could lead to better results, right? It would simply be, well, kind of stupid, or should I say irrational, to take on more risk and get nothing for it. So what if I told you that this trade-off between risk and return, something I at least take for granted in my everyday life, so not just when it comes to investing, is actually a relationship that should hold statistically and empirically, but often does not. But before we jump into that, I think it's important that we first start by defining risk. And since we are on that topic, I think it is worth also defining uncertainty and radical uncertainty. Personally, I find it easier to remember these things when I compare them side by side, especially when they are closely related. So what do we actually mean by risk? Well, let us say you're playing a game with the regular 6-sided dice. You do not know what number will come up, but you know there is a 1 in 6 chance for each side. That is risk. The outcome is uncertain, sure, but it is an uncertainty you can measure. You can assign probabilities to each possible outcome. This is basically how finance defines risk. You know the range of possible outcomes and you can put numbers on how likely each one is. Whether those probabilities are based on objective data or your own gut feeling, what economists call subjective beliefs, as long as they can be expressed numerically, you are in the realm of risk. This distinction goes all the way back to economist Frank Knight, who in 1921 drew a line between risk, where possibilities are known, and uncertainty, where they are not. Uncertainty then is something different. So now imagine you are handed a dice, but no one tells you how many sides it has. You roll it, but you do not know whether you're looking at 1 in 6 chance, a 1 in 20, or something else entirely. You might still know some of the possible outcomes. Maybe the dice only has numbers 1 through 10, but you cannot say how likely any of them are. That is uncertainty in the Knightian sense. You are operating in a world where probabilities cannot be assigned, either because you do not have enough information or because the situation is too complex or unfamiliar. So finance theories tend to like risk because it fits neatly into models. Uncertainty, on the other hand, is messier and unable to quantify. And then there is radical uncertainty, the real wild card. This goes a step beyond even Knight's uncertainty. So here you do not just lack probabilities. You do not even know what the possible outcomes are. So it is not that you are unsure of how many sides the dice has. It is that you are not even sure if you're rolling a dice, or flipping a coin, or playing a game you have never seen before. Think of events like the 2008 financial crisis or the COVID-19 pandemic. For many of us and investors, those were not just unpredictable, they were unimaginable at the time. So radical uncertainty is about those situations where our existing mental models and expectations fall apart completely. Okay, so now we have a better understanding of what we mean when we talk about risk. So when I say that the trade-off between risk and return does not hold, I mean that the linear relationship between the two, assumed in investment theory and in security pricing models like the capital asset pricing model, often breaks down when tested or applied in real-world data. I do not intend to go too deep into how the CAPM works, the capital asset pricing model, but put simply, if the security you are valuing is riskier, meaning it has a higher beta, you as an investor will demand a higher expected return to hold it. And since price and expected return move in opposite directions, that means you would be willing to pay less for the riskier security compared to a less risky security, all else equal. I think we need to quickly talk about price and expected return because it is one of those relationships that we come across or mention often, but we forget to slow down and explain. So here's the basic idea. The lower the price you pay today, the higher your expected return in the future. And vice versa, the higher the price you pay, the lower your expected return. Very simple. But think of it like this. So if you buy a stock today for, let's say, $90 and expect it to be worth $100 in a year, your expected return is a little over 11%. But if the same stock costs $95 today and you still expect it to be worth $100 in a year, now your expected return is only about 5%. So even if what you expect to receive in the future does not change, what you are willing to pay today determines your expected return. This is the logic behind why investors might pay less for a riskier asset, not because they think it is bad, but because they need a better return to justify taking on more risk. So the lower price builds in that higher return. This is why in models like the capital asset pricing model, higher risk as measured by beta leads to higher expected return and therefore a lower price today, ceteris paribus, all else equals. Okay, that is all good. Now to the main point of this episode. It is exactly this relationship, so the theoretically assumed positive linear link between risk and return, the idea that the more risk you take on, the more you should earn, that empirical studies are unable to prove. Or to put it a bit more carefully, though perhaps with less punch, empirical research tells a much messier story. So a long list of studies spanning decades have tried to test this relationship in real market data, and the results? Inconclusive at best. So many find no statistically significant link at all, others find the opposite of what theory predicts, so more risk and less return. Only a few studies manage to uncover a positive and significant relationship, and usually only in very specific contexts like daily data or short time horizons. In other words, the foundational trade-off between risk and return is not something we can take for granted. I'm going to say that again. The foundational trade-off between risk and return is not something we can take for granted. That said, some researchers argue that the issue might not be with the theory itself, but with the way we have been testing it. So in a detailed study, Bali 2008, which at the time of publication of the article was at Baruch College in New York City, where I actually studied for an exchange semester long ago, he shows that when we stop separating time series and cross-sectional perspectives and instead estimate them together using more refined models of conditional risk, a positive risk-return relationship does start to emerge. And do not worry if you did not understand all those details. The important point here is that maybe the trade-off does hold, but only when we are looking at it through the right lens. Okay, so if you liked this episode, please feel free to share it with someone who might enjoy it too. I talk about finance, accounting, and investment theory, especially the ideas we often take for granted, but that do not always hold up under scrutiny. The goal is to offer a more nuanced perspective and hopefully something that is both thought-provoking and useful. Oh yeah, and I'm new to this, so any help spreading the word is genuinely appreciated.